Hello and welcome to a new series of Candid conversations from Octo Members. I'm Katey Pigden, Content Director. I'll allow my guests to introduce themselves. So Dave, over to you.
Hi, Katey. I'm David Ferguson. I am the Executive Chair of Seccl, a position I've held, I guess, for a couple of months now.
Tell me about that then, Dave. What does this executive chair involve?
Yeah, well, I was previously CEO, and now I am doing this role, which is, in some respects, parts of it the same. So I'm still doing a lot of work on growth, on sort of strategy development and culture and that sort of stuff. And we had a great new CEO, Jonathan Dees, to run the business as CEO. So he took up the position, I guess, a couple of months ago, something like that. And so I'm spending more of my time either on the sort of, if you like, the more formal parts of being the chair of the company, but also just making sure we're growing the business as we like to and opening up new conversations and new opportunities. So it's a very exciting time for the company. We're growing very quickly at the moment. It feels like a really exciting next few years, hopefully coming up. So hopefully I can be a success in that new role.
Excellent. And for anyone that doesn't know what Seccl is, what Seccl does, could you give us a bit of a
Yeah,
brief?
Seccl goes under a sort of label of an embedded investment platform. So it's essentially all the back end technology and operations that allow you to run an investment platform. And we do that for financial planning firms. We do it for sort of wealth managers right through to sort of D2C platforms. So really from businesses like Soderbergh or Cooper Parry through P1, through Timeline's platform, all the way through to running platforms for people like Chip and Prosper and Monzo. So the back end, it'll be Seccl's technology and operations running that. So much in a sort of modern day version of some of the technologies that sit behind some of the kind of more established platforms in the market today.
Your background, Dave. Do you want to talk us through how you got to
Sure.
this stage?
I can do that. I'm quite old now, so I need to try and remember all the way back to the beginning. But yeah, I'm a kind of failed actuary by background. That's how I got into this thing. And I was a bit of a computer geek at school, so that's the really old background, I suppose. I worked for a couple of insurance companies and asset managers early in my career. And then Philip Martin, I had a business called The Abacus, which is a little consultancy business, which he ran for a few years. Then founded Nucleus in 2006, I think it was. And then did that for about 15 years or so, I think it was. We listed that company and then it was acquired by private equity in 2021. And I took up the CEO of Seccl in early part of 2022. And here we are now. So
Yeah,
happy
excellent.
to, happy to elaborate on any of that as you wish, but it's, the older stuff's...
Like leaving Nucleus then, Dave, because
Oh, do you know,
obviously a long time there, your baby.
yeah, it's funny. It's an interesting question. It's quite an interesting transaction that happened during COVID as well. And
Yeah.
essentially, what happened is our major shareholder, although we're a listed company, Sanlam owned majority of the equity. And when COVID happened, they essentially sought to exit a bunch of investments they had in the UK and elsewhere. And we got went along with got caught on that wave, if you like. And so it was a very long process, actually. Not necessarily just because of COVID, maybe just complexity in it. So, but to be honest, by the time I left, it'd been quite a weird time of everyone's life doing this sort of transaction, sitting actually mostly in this room, funnily enough. And I was actually just glad to move on, to be quite honest. By the end, we had a great time for 15 years building that business from nothing. It was a great experience, and you learn a lot of stuff along the way. And to be honest, once I left, I remember taking a selfie at the front door, and I kind of left. I left very quickly at that point. I was out of it in every respect, and by then I was happy to be so. So yeah, it was, and I've still got, well, not so much now. Actually, a lot of people have left that business, but for a while afterwards, I had quite a lot of friends there and people we'd hired and stuff who, I was obviously concerned that things were going to play out for them as well as I'd hoped they would. Hopefully, that's been the case. And mostly actually now, most people I think have moved on. To me, it's just like another business in the space now, to be honest, Katey, rather than anything that I had any particular attachment to. Because I think it's obviously been through it's part of it was part of James Hay when they acquired us, and then they went and bought Curtis Banks and Third Financial. So I think it's an extremely different business in every respect now. So while it has the name above the door, the only thing that we always thought was a great name for a company. I remember it took us years to come up with it.
So how did you come up with it, actually? Because my
Well,
husband's a scientist, so he's very much like, oh, what?
well,
Hold
the
on.
absolute,
And I'm like, oh,
the
well.
absolute honest truth is an idea we'd had quite a long time beforehand, right? And the idea, it wasn't so much a physics thing; it was more of the idea of a central point or a meeting place or where stuff happens in the middle, right? So, and even our logo in those days was meant to represent a sort of fire type thing, a sort of burning thing where ideas and people would gather around it. So, and actually, it was actually one of your ex money marketing colleagues that reminded us of the name. Actually, oddly enough, we were trying to come up with the name as we got closer to the funding, and then a guy, Chris Duncan, who you maybe know,
Yeah.
he suggested
Actually,
Nucleus.
a current colleague.
Of course, yeah. Sorry, yeah.
It's your business now.
Of course, yes, yeah. And Chris suggested Nucleus. I remember standing outside Bond Street Tube Station actually on a call with him, and he suggested. And I was like, "That's a brilliant idea." We had it before, but we kind of dismissed it or forgotten about it for some reason. So that is a true story. That's where the Nucleus name. So Chris Duncan is probably the guy who needs to be credited for bringing it back into our heads at the very least. You know.
Or at least get him on an interview at some point then, and
Yeah.
he can have his 15 minutes of fame as well.
Yeah, exactly. Yeah. So I thought it worked really well because it was a sort of we did a lot of stuff, right, trying to get everybody involved in the ideas. You know, the advisors were very much in the planning of the platform, and there were shareholders as well. So this kind of theme that we would, let's say, gather around something and kick around our best ideas and actually share best practices amongst ourselves as well. So we had a thing at Nucleus, which was called Illuminate, I think it was called, which is basically advisors either online or even in offline settings, just sharing best practice and trying to improve themselves and improve their standards amongst each other. So like, it I always kind of liked the name of it. I still like the name of it. But anyway, there you go. That's the background.
Yeah. Well, I remember while I was at Money Marketing, I was probably one of the pests that was asking you what was going on and realizing that this was all happening. But I remember thinking when it was James, there was quite a few companies that were in the mix, and then some would drop out, and sort of that rolling on. And I remember it was probably in a December period. I remember doing it as on the first day of Christmas, like this was happening, was happening, and all of that stuff. And I think I actually managed to get the exclusive that the Nucleus name was staying.
I think the history was that James Hayes' reputation was probably not as positive in the advisor market. So at one level, the Nucleus is probably the stronger business, if you like, at that time. I think it's always difficult when you merge two businesses to decide what it should be called or whether it should be a new name altogether and all that kind of stuff. And the guy who was running it was Alex Kovacs, who'd taken over as a chief commercial officer. And he appointed an agency to go through all the options, I suppose, which I can't remember. I guess they would have included James Hay or Nucleus or any version. I don't think there's an easy combination of James Hay and Nucleus that you could form, so sometimes that happens as well. So I don't know, I was surprised. It was quite an interesting move. I think, and actually they very quickly did all the change of the brand and look and feel and stuff. So although they retained the name, it felt pretty different pretty immediately anyway. So yeah, and I think obviously since then they've acquired Curtis Banks and Third Financial, and I guess it all under, what do they call it? Nucleus Financial Platforms Group or something like that. They call it now or something like that. So yeah, it's fine. Well, yeah. Move on.
So what was it about Seccl? Did you have much of a period in between? I can't really remember.
Yeah, I left in the September, and I was under, sometimes you can't speak to people for a little while after those things happen. And I had a few conversations with different people, couple of startup ideas that were in my mind. I was very keen to do something else. I wasn't in a position where I was going to stop working on that and actually Hugo Thorman, who you might know, he called me to say, what about getting involved with Seccl? And to be honest, I'd thought that Seccl was pretty well set. It'd been acquired by Octopus a year or two earlier, 2 years earlier, I think, and had sort of joint CEOs. There was founder Dave Harvey and a guy called Sam Hanfield-Jones who came in from Octopus. So to be honest, while I'd seen the business, I sort of observed it starting and I was aware of it and a lot of respect for what they were doing. I hadn't actually considered there be a vacancy, to be honest, or an opportunity to get involved with it. And so it was always, if I'd known that, it would always have been of interest, if you know what I mean. And actually the sort of startup things I was looking at were probably very Seccl-like, to be quite honest, in terms of what they might do. So when that conversation opened up, when Hugo called me, I guess I went and chatted with him, and then I went and met Ruth Hancock, who's the chair, and she'd done the deal to buy Seccl into Octopus. And when it became apparent there was an opportunity for that role, I was very excited about it very, very quickly, actually. And these things sometimes take a few weeks to take form. So I had a couple other things I was kind of running alongside in case that one fell over.
Yeah.
as you do, I suppose. And it became quite exhausting actually because I was very, very clear I wanted to do the Seccl thing, but I was trying not to let other people down, or if Seccl hadn't happened for some reason, let myself down. So that was great, and it was really, it was and it remains a very exciting business. I think hopefully over the last it's been 3.5 years since I was joined originally, it's begun to take a bit more form, and it's grown very substantially in that time, and it feels now that the opportunity is really massive for the company. Actually, that's a very exciting thing to be involved with, obviously.
So you like that disruptor role then?
Not just for the sake of it, when gone back to the very beginning, I was a bit of a computer geek at school, and also I sort of doing the actuarial stuff, and in my very, very early career, even my first year or two, I just found it very frustrating how things worked, to be honest, Katey. I felt there was opportunity to do things much better and to make them better for customers and more efficient and all that kind of stuff, more transparent, actually, because this is a long time ago, before, obviously, many, many years before RDR. So it felt to me there was a long way to go to improve how everything worked. And in fact, if you looked at even the original Nucleus business plan, would have talked about the advent of the internet and the impact it was having on certain industries, on transparency and making things better for customers. I mean, it wasn't really happening here. So to be honest, I don't really do it for disruption's sake. It's more, I just think we haven't made it as good as we can yet. And the fact that it was Nucleus for 15 years and now it's been Seccl for best part of 4 years and hopefully many years to come, that's what actually really interests me. I just don't think we do a very good job for customers yet, or not nearly as good a job as we can. And it's actually been fascinating working with Monzo this year, because they've obviously massively customer-focused business. The user experience is brilliant, all that kind of stuff, and just seeing what can happen in that case in a D2C business, direct business, and how brilliant it can be, and then think, well, surely to goodness there must be aspects of that we could still bring to this and deliver something amazing, financial planning at the front of it, but the execution piece being really cool and really efficient and engaging, frankly, for the client. And I don't think in general we've traveled as far yet as we need to. But I find that super exciting. Yeah, and I'd say the fact it's happened for me, and as Nucleus as a startup as it was for me, and now in Seccl, which was I suppose we'd call a scale up business. Yeah, it's not to be disruptive for the sake of it. It's more because I think it's the right thing to do.
Yeah. Do you know the history of the name Seccl, how that's come about?
I do. So Dave Harvey, who's the founder, came up with it, and he's an engineer, right? He's not a marketing guy, but it's short for securities in the cloud. That's where it comes from.
Ah, okay.
Yeah.
There we go. See, I've learned something new. I was
Yeah.
like
So
that.
and I think at one point there was a discussion about, when it became part of Octopus, whether we should retain that name or not. And I think we felt by then that it was kind of well enough known and regarded that we should continue with it. So yeah, that's who we are, and we get asked that question period, not quite as much as you might expect. Actually, I think these days so many kind of tech type companies, or all companies, have got sort of slightly unusual names that not
Yeah,
necessarily
I
words in
think
the
when you're trying
dictionary.
to think of a name of like, well, what's short
Yeah,
enough, what hasn't been used already.
yeah,
Yeah,
exactly. Yeah.
there's a lot of challenges. So what stands out? Funny enough, in a former life, actually pre-money marketing, I used to work for a publication called Utility Week.
All right.
And
Okay.
so Octopus Energy
Yeah.
was a company that I wrote about and
Yeah.
got to know. I know for them, it was very much that customer service focus
Yeah.
as well. So does that carry through with Seccl then, of trying to
Yeah.
improve
I, th- I
stand?
think I think it's really interesting because so Octopus Energy is also an amazing business, extraordinary success story, and I think if you look at different sectors, in energy, one of the great failures of that sector historically has been customer service. For example, is one of amongst other components, right? And so they are, I think, been really set a new bar for what people can expect there, and held themselves to it. I think it's interesting in our world. I think our customer service is good, and it should be, needs to be, all that sort of stuff. More of what we do is more the technology and the back end operations, if you like. So while we definitely want to have great customer service, what we're trying to deliver in the round, just as Octopus Energy is something much better for customers. In our business, that will be probably more about the automation of the activities than it is necessarily about when you pick up the phone to somebody. But the general principle is, how do we make this whole thing better for people on the other end of it? I say in Octopus Energy's case, that'll be for retail customers. Although actually they also, you might be aware, the software in Octopus Energy, which is called Kraken, is also licensed out to other utility companies all over the planet now, actually. And I think Seccl, in some respects, is to managing investments to what Kraken is to managing utilities, right? And I think strategically, Octopus kind of see it that way. So the same way you've got Octopus Money, if you like, as the retail brand, and Seccl sits behind that as well, actually, as it does behind, 20 or so other platforms. There's probably a bit of read across there,
How important is that backing from Octopus? Because it seems like they've doubled down on it.
It's massive. I mean, I can't actually emphasize it enough. I think when you're trying to build a business of substance, right, that's trying to do a really big thing in a fairly competitive market, the fact that we can make decisions for the long term and not have to always be raising money and dressing the company up for a transaction every 2 or 3 years, which is usually what happens in these things, is just transformational. So, Octopus has backed us very heavily to do this disruptive thing, and it's been an amazing shareholder for the company and remains so because they're taking a 20-year view of it, right? And I believe I understand it's the same with Octopus Energy, and you don't get to build these businesses over 1, 2, or 3 years, and it's done because it just isn't. It's a complex, high investment, lots of requirements to build. And if you look at other firms in the space, whether it be in the platform space or at the back end of the platform space, the number of them that have had issues due to shareholding or change of shareholder or having to raise money or think about this, think about the sequence of transactions they've got to do to get to a profitable state. I think a lot of the issues in the platform sector today have actually been caused by changes in ownership in the last few years, and you see it as well with some of the technology providers behind the space as well. It's almost like the requirement, Michelle, obviously, requirements obviously massive alongside customers and people that work in the business. But when businesses have been run entirely for shareholder interests, that's quite a difficult place to be, because you've got long-term businesses here which are hopefully sitting as infrastructure for 5, 10, 15, 20, 30 years for customers, and they're kind of getting recycled through shareholder cycles that maybe last 3, 4, 5 years, and there's a inconsistency there, which I don't think always plays out well. So having Octopus backing us as heavily and boldly as they have has been, I mean, just the absolute ideal shoulder for the business. There's no question about that, and it's been a great asset for us to really build upon.
So what are some of those problems in the platform sector, Dave?
Well, I think you've seen.
How long have we got?
Yeah. I think I've only got an hour for this. I think you've seen a bunch of businesses that were acquired in the last few years, maybe going to private equity ownership or different ownership models, and they haven't necessarily pushed on because they've been getting run in order to sell it again in 3 or 4 years' time. And I see it's this point about long-term investments. You've got this misalignment between the interests of customers and wanting stability and longevity. And you can see it comes out if you look at the things like the inflow numbers into the space that Fundscape and LineCap pull together and circulate. The net inflows into the space, most companies are in net outflow or very close to it and have been for years. And that's not good. I mean, these businesses get valued on margin, but also on organic growth. And loads of these businesses are not growing organically. I mean, I saw actually this morning, funnily enough, Transact's share price up 5% because they had a decent little period of net inflows again. But it used to be that I think back when I was at Nucleus as well, and certainly Transact, it wouldn't be unusual for these businesses to grow organically at 15 to 20% or even more per annum. That would be quite common, right? And at the same time, you'd have the wealth managers like Rathbones and Brewin Dolphin and such like growing at 2, 3, 4, 5%, 2, 3, 4, 5% per annum, and that would be reflected in the multiple the market would put on those companies, right? And what you've got now is a platform sector which is pretty much not growing. I mean, I can't remember the numbers for last quarter, but the net inflows were something like it's a tiny. It's realized it was. I think it's growing at something like 2 or 3% per annum or something like that. The sector, that is not a healthy position to be in, and it ultimately comes to valuation. And then when people are looking to sell the business in a short period of time, they don't have time to maybe change the margins that much, so they've got multiple issues. So the exit's not going to happen the way they want it to. So a bunch of owners who are kind of thrashing around now, and you can see some of the companies trying to, we'll bolt on we'll buy a couple of IFAs and make it look like a 7IM or something like that. And it's not. Or we'll outsource the admin to some kind of outsourcing business, and that will hopefully help the margins. And I'm not sure all these things are necessarily going to play well for users as advisors or for customers. And that wouldn't have happened, frankly. It wasn't happening, 5 years ago. So you've had this kind of change in ownership, and it's triggered a bunch of behaviors, a bunch of actions that I'm not sure are necessarily terribly positive for the people that use these things.
And potentially we'll see another one change hands. There's talk of Aegon's UK
Yeah, that's right.
could
Yeah.
be a platform in the mix
Yeah,
there.
that's right. Exactly. And that's a good example. I mean, if you go back long enough, you had, Scandia, as it called now, Funds Network and Fidelity and co-funds were the dominant fund supermarkets by miles, lead up to RDR and around that time. And then to some extent, variously lost away for a while and then recovered or didn't. But I don't know for sure, but I'm not sure that business has grown organically in several years. Yeah, you're right. That's in the market now. And you've had obviously with M&G was up for sale, or was or was not up for sale, whatever, depending on you believe in the media reports. And you've probably got some others, that are private equity owned coming up to the end of their investment cycle in the next 12 months as well. So without wishing to sort of name names, wouldn't shock me to see 4 or 5 others come round into the processes over the next 12 months, and none of them have delivered anything like what they thought they would in terms of valuation. I don't think for their owners, and that'll have consequence, right? Maybe transactions get rolled over into continuation funds or something like that, or maybe they'll will be slightly more distressed. We'll find out obviously how people choose to act on these things. But I think you had before. It felt to me really since about 2000, you had a bunch of businesses doing pretty decent things, trying to make the sector work better. You had, generally speaking, you had pricing going in the customer's favour, and that's all stalled. I mean, even when interest rates went up and a bunch of platforms started just keeping a bunch of the margin on cash, so the actual revenue yield of platforms has gone up quite a lot now in the last few years, whereas it's been on a probably slowly but gradually declining trajectory where you saw some of the scale benefits of the sector beginning to be shared with customers, and actually that's completely flipped in the opposite direction if you include the sort of more the less visible fees around things like interest on cash and stuff like that. So yeah, it's very interesting, and frankly, in our own business, we just see that as a massive opportunity, to be honest, to deliver something at a time when technology has actually allowed us to operate at a level of efficiency that's miles beyond what's been done before. You've got this kind of new model coming in, whether it's us or others. Someone like probably Ola's business at Fundment is much more efficient than some of the others you'll see in the space as well. So you've got this kind of next generation, more tech-led businesses. At the same time, you've got more admin businesses with maybe the wrong owners or owners with different pressures. So it makes it very exciting if you're in the next wave of it.
Do you think the sort of so-called established players haven't been looking over their shoulder enough as to what's coming up behind them?
I don't know. I mean, it's not been that hard to see it. I mean, I think what happens though, if you're £100 billion or £50 billion or £200 billion business, you tend to have extreme complacency against really small players. I remember actually having a couple of mates who worked at Standard Life when we were starting up Nucleus, and they were just, who are these jokers? They're tiny, they're irrelevant, they're never going to be part of the market. And then guess what? We were, right? And I think it's a really dangerous thing to do. And I think you'll find that you see it if you're a asset management business, you might consider your peers to be other asset management businesses, or if you're a life company, you see them as life companies. So if you're Aegon, you're probably worried about, or you're probably looking at, I don't know, LNG and Aberdeen or something like that, or Phoenix or something. Whereas if you've got a Seccl type business or fund that I mentioned earlier, I don't see why they can't win over the next few years. It seems entirely reasonable. They've got better technology and better products. They've got more focused management, frankly, than what they're trying to do. And just as actually when Ian Taylor launched Transact, I was like, what is this? This is mad. Who are these crazy people? This is like no one even heard of a wrap platform in the UK at the time.
I think that idea came in a pub, didn't it? I think.
Yeah,
from
exactly.
having
And look, God, they're still at it 25 years later. It's been a wild success, and people have loved it mostly for that time. And I bet if you were sitting in, any insurance company back in the year 2000, 2001, 2000, when they were getting started, you just be like, well, that's going to be a fad. That will fade away. And in the end, they defined the market way more. And in fact, Ian, was sadly obviously departed, was a really good friend of mine, and he just said the best thing that happened to Transact, I think, was the launch of Standard Life Wrap, actually, because it validated what Transact were doing, and it made it sort of acceptable. It took it away from being this kind of edgy, needs to be an early adopter thing into something that was a bit more mainstream. And I think you'll see that happening now with some of these new businesses in the years to come.
Do you think there's room in the market for as many platforms as we have got?
Yeah, I do. I think that you'll see more. I mean, we're now running obviously lots of platforms for individual firms now. So at one level, I think on the front end, you can have as many platforms as anyone's got differentiation to support, really. I think at the back end, the bit we're at, I don't think the market needs loads of that. That's a sort of utility type service, and I don't think it's helpful to have 20 or 30 of them. That feels like a really bad idea. So, I can imagine a market where you've got hopefully Seccl, and you might have, likes of kind of FNZ or CI or Pershing or something like that, or SS&C, whatever, sitting as the back end infrastructure. And that will be one part of the market. That's like the back end, scalability, high resiliency, all that sort of stuff. I think the front end, I'd say whether it's the firms that work with us or work with others, I think what does get interesting is what is the added value of the person or the organization on the front, right? So if all you're doing is putting your own colors and a logo on the front of a back end, I'm not sure there's necessarily enormous value in that always. So I think you either bring something to the party, either you bring another technology or investment proposition or some CRM system, whatever it might be. So the idea, I remember actually some guy from, I think it was the banking sector, was talking about, what's going to be the end of the last stage of banking technology, or whatever. And it was basically it's just going to disappear into the background behind something else, And I think this is the same. So if I look at the businesses we power and the difference between them, there's far more difference between the 25 platforms we power than there is between the 25 platforms that make up the advised platform market today. And I think that's where the differentiation lies. And if you can't demonstrate differentiation, either say in the proposition, price, whatever it might be, I'm not sure that's a thing anymore. I think that's a really difficult market to be in as a standalone business.
So are more advice firms wanting to play in that space then?
Yeah,
And
totally. I think similar. I mean, whether it's triggered by wanting more control over the proposition, whether it's controlled by wanting a lower cost proposition for the clients, more digital experience for the clients, some of those could be delivered by legacy platforms, or more stuff that could happen, or in theory could happen. But I think a lot of time, either technology or the commercial frameworks that exist there don't permit it or don't make it easy to do that. So yeah, I had someone a while back saying this advisor's platform model's dead, and it's complete. Never. I mean, it's just garbage. I mean, we have more and more conversations on the go now than ever before. And I think what you had was an early wave where a few people did it, and some went well, some didn't go well, and everyone's like, "Oh, is that going to be a thing or not?" And you get it flattens out a little bit for a while. I think we've got I think we put 4 or 5 live in the last few months. We'll probably do another 15 next year or something like that. I don't know, some number like that. And so there's no way this is going away because it's demonstrably better, frankly. And if you're sitting especially when you get more consolidation or bigger advice firms, why on earth would you want to, if you, let's say you're a private equity owned consolidator, right, and you've got 10 billion of assets, why would you want to leave money on the table for the owners of a platform business? You just wouldn't do that. I mean, there's no, that's not what
it's because it's the safer option.
But is it? Is it?
That
Yeah.
done.
Well, it sounds like the safe option until you realize half the platform businesses aren't performing as they should at the moment, and the service has gone away, and the propositions haven't evolved. So yeah, it might be safe in that. You get that line, nobody got fired for firing IBM, but they all did later. just because you make an easy decision today doesn't mean it's actually the right decision 2 or 3 years later. So I think you're seeing that at the moment, definitely in the space where whether you call it advisors platform or just advisors taking control of technology is another, the language doesn't really matter. But yeah, the idea that, I don't know, say some private equity group that's got £10 billion of advice business is going to leave 10, 15 basis points on the table for a legacy platform, I think it's just nuts. I mean, it's just, why would they?
Yeah. So what are some of those other issues? Because transfers has been a bit of a hot topic.
Yeah.
I remember writing about that, and the transfers in may be handled better than the transfer out.
Yeah, it's funny, and so I see it in Seccl, and we see it. I'm actually on the board of the Platform Association, and I run the transfers working group thing there. And what you've got there is, I think, a whole bunch of issues. To be honest, Kate, I think there's stuff about, there's technical barriers. So sometimes companies can't get the technology to work properly, or they can't integrate well enough with things like Origo and Equisoft. I think there are, without doubt, there've been commercial disincentives, if you like, to invest in certain, transfers out, for example. And there's actually just the other industry parties. So things like fund groups can sometimes get caught up in this. So if you're doing a kind of in specie transfer, you can have a problem because the fund group in Ireland or something doesn't do electronic transfers, that sort of stuff. So it's a bunch of different reasons. I would say that if everybody just used the technology available with the greatest level of integration as is available, we'd already be way better off, right? So
Yeah.
it's funny, and one of the parts of our business we rebuilt about 18 months ago in preparation for scale was the whole transfers infrastructure. So we're fairly well informed on the topic. And we're now doing on any given day between probably 10 and 25% of all the transfers in the UK. So we're doing volume through it now as well. And the real life is that if you use Equisoft rather, and Origo as fully as you can, and you've got properly integrated systems and all that sort of stuff, and you use things like exception codes properly when something goes wrong. If you request a transfer from, I don't know, Aviva, say, and let's say you've moved address since you took out the Aviva pension, they will quite rightly reject that transfer request and ask for your old address or whatever to make that happen, to make it proceed. If you do that all really well and slickly, which is all entirely possible, so have a sort of Deliveroo type model where you make the request, you can see what's happening all the way through, we could be far better off. And that's the work really that the platform association is trying to do, because you obviously can't just do it yourself either. So we've actually invested the monies, spent the money to have good infrastructure for this, and not everybody's done that yet. And what you've had is a bunch of people talking about this for about as long as I've been in the industry. I mean, there's been a 25-year, 30-year discussion. It has got better all the time. I mean, there's no way it's as bad as it was 10 years ago, or even 5 years ago. But it's almost like customer expectations have moved much more quickly than the industry has. So the idea that I've got to wait for a certain period of time, or I can't see what's happening. Something I think is I can't see that what's happening is worse than the wait.
This is my thing. Where's it gone?
Especially if you want to do something with it, like you trade it or take some income, whatever it is. And I think so. There's two bits. One is let's make this as slick as it can be from a tight durational point of view, but actually maybe the more important, or at least as important, is what's the communication process in the middle. It says, right, okay, this has been sent to the seeding company, they're dealing with it, whatever the thing is. And I think that's the thing we're trying to get to. And there's been quite a lot of initiatives over the years, like there's an industry initiative called STAR, which was all about MI. And while that is definitely valuable and valid, I guess what we're trying to do is put more weight on making the thing better rather than just improving the reporting of how bad it is. So if someone's got like $1 million to spend on this, put 900,000 on making it better and 100,000 on reporting on it, rather than the other way around. I think we've sometimes had a little bit of let's invest in the reporting, and so we all know how bad we are at this. That
about the problems, but not necessarily.
I want us going to fix it, right? And then, because in the end, if we fix it, no one's going to care that much about the reporting, right? And so we're trying to orientate that way, really, and also what it feels like for a customer, which really often starts before the provider even gets involved, right? So it could be letters of authority, data gathering for a financial planner or IFA to even know what needs to do to start the process off. So how do we make that better? And if we make that better, then the whole thing and communicate it better, then I think, frankly, if you get a little long tail that still take 90 days, I'm not sure anyone's going to care that much, because the real life is if you've got a transfer that's got like a commercial property in it, or some complex asset in it, then the real world, it is going to take a while, because it just is a messy process, and we're probably never going to automate that. Actually, it's not even worth them trying to.
What other challenges is the Platform Association trying to address? Because I assume this is all different platform bosses round a table. So just usually, but coming together.
There's different stuff. There's different work streams. There's some on AI and some on cyber and resilience, that sort of stuff. So I guess what we're trying to do is get a coherence to the industry. I think there was a group a while ago, which I think maybe still runs, called the UK Platform Group, and there was a time round about RDR, for example, that was a pretty active group, and it was helping the FCA understand not necessarily where people wanted to have commercial advantage, but it was more what are the operational realities of things like what do you call it, like AMC rebates and stuff as it was back in the day. Yeah. So not just trying to make sure the regulations were well informed on the real life of running these things. And I think that group somewhat fell into disarray. There's a lot of, I think it's not to make a point about seniority, but senior people stopped going to it. So it ended up being kind of quite a middle management thing. And no one who was going there could make anything happen, right? So they'd say, well, let's do this. And then they go back to their business and nothing would happen. So when the platform association was getting discussed, it was much more like, if we're going to do this and it's going to be representative, it's also got to be empowered. It's got to believe that if we're going to, create expectations on how companies should deal with operational resilience or something like that, then we want everyone to sign up for that and be committed to it, because otherwise you end up with a very fragmented space. So it was amazing, actually. I mean, remember actually Ian and Ed Dymott, who at the time was at Fidelity, then later co-funds. I mean, they did great work around RDR, and in the end they were, Transact, those businesses were competitors, right? But they sort of represented that group with the FCA on some of the just real life stuff that you couldn't just write the regulations straight through, because it actually just wouldn't work. So I think these groups can have real power as long as they focus on things that genuinely make things better, and which don't run into too many competitive advantages, because people withdraw at that point and they don't want to be part of it if they think they're losing their edge on some things.
And so it's not just discussing the problems then and not moving forward.
No, I don't think so. No, I mean, we've had I think the transfer ones was one of the first to be set up, and we probably that one's had most traction possibly so far. But no, I think over the next 2 or 3 years there might be 8 or 10 different groups targeting different areas, and some may be temporary, right? They exist for a while for a particular purpose, and then they kind of step down again because that problem has been solved. And actually, frankly, if we make the progress we hope and expect to do over the next 2 or 3 years, then transfer one, it may not be disbanded, but it might have less relevance or be less important, because it's actually, we've reached the stage that this is all fine now, or it's pretty much fine. It's not worth such intensity. So I mean, we've got good engagement from the platforms. We've got good engagement actually from the tech and back end providers. So there's a really great guy in that group from FNZ, for example, who's been a really good guy at Transact as well, who's been really prominent in it and moving things forward. So yeah, I think it feels like there's definitely stuff happening there. And frankly, if it gets to the point it isn't, everyone will just get pissed off and stop going to it, right?
A new group form somewhere else. So,
well, hopefully not. Hopefully it won't come to that, yeah.
About the long-term thing of growing Seccl and obviously your new role in that strategy and stuff as well. But it is challenging to disrupt the market. And we know these things take a while to turn a profit. And,
no, definitely,
overcome there. So what's this plan there to turn that around? So
it's just really exciting, Katey. I think these businesses like ours are kind of by definition scale businesses. They kind of have to be, because you're not going to build a business doing this that manages 10 billion of assets and have any future success. So, we want to build a multi-100 billion pound, trillion pound business over the next, 5, 6, 7 years, whatever it might be. And that's what we go and do. Seccl's actually 10 years old, which would be a often overlooked fact.
Yeah.
And we've spent a lot of time building and building and building. And now we've got a kind of product that is relevant and scalable and resilient and all that kind of stuff. So I guess for us now, we've probably only in the last, I'd say year, if even year, really moved into growth mode. Other people have tended to grow their businesses and the products failed along the way, and they've kind of had to shore it up or whatever. I think we built something the right way round, if you like. It's a product-led company, that's what it does. And now we're in growth mode. And I say, as we touched on earlier, Octopus is a brilliant shareholder. We've just probably taken our growth team, which until recently would have been like literally a handful of people. It was like, tiny. Is probably, I don't know, there might be 15 people on that now, something like that. So that's kind of flipped into that mode. And Seccl was super interesting even 10 years ago, 8 years ago, 7 years ago. When I joined, it was definitely interesting to join. Some people won't get on board with these things or choose it until it's got enough evidence. We've been really growing the business for the last building the business for product and stuff for the last 10 years. And now it's firmly into growth mode. So it's very exciting. And we're growing a sales team. We're getting loads of conversations. We kind of into, if we want every single thing we're working on just now, we'd probably be a 600 billion pound business in 2 or 3 years time. So it's very exciting, and it's hard work, but it's good fun. It's like, it's nice to be winning,
So where are you now, Dave? What's that figure looking like at the moment then?
We're about 6 billion. We're about 6 billion. We've gone through 3, 4, 5, and 6 billion this year. All of them. So hopefully we'll go through several more. We expect to go through several more next year.
And what are some of the challenges you're going to have to overcome to get to that point? Because obviously, if you disrupt the market, it takes a little bit of time to get there. And then I suppose there's the risk of then, do you become this established, serious player in that sense?
Well, we want to become a serious player, and we want to be established. We want to become the establishment. You know, it's one of these funny things, isn't it? Yeah, I think that's slightly different now. Is technology is way more modular, right? So there's no reason on earth for the technology to get old. I think that's the big difference. This is much more easy to keep it up to date and maintain it. So things like scaling the product and scaling our operations, I think we've got a good handle on that. So I think we know how to do that. Scaling the company obviously just brings obviously usual people challenges, and you're trying to scale, not lose the culture, not lose the edge, not lose the way of being. I think we can do that. We feel pretty good about that. I think at the moment that feels achievable. So for us, it's more we're finding ourselves sometimes speaking to larger firms than we have in the past. So actually learning how to sell to them and be able to be in that room and know how they behave is a little bit of a skill we're developing just now, which is not necessarily terribly well ingrained in our business. A lot of the time people make decisions, the people we speak to now might make decisions with they might have a consultancy firm involved in that process, you know, like a Big Four or whatever. You know, are we working that well enough? You know, so when we think now about the sales strategy and the people we've got working on the sales side, there's a bit more. If we're facing off to different types of firms, have we got the skill set and the experience to do that in different ways? No matter kind of what we think of each way people do it, that's the way they're going to buy it or not. So, so there's a lot of that going on in our heads at the moment, and we're working on that. But yeah, I mean, I think we've got decent momentum now. So we've gone through business about 3 times the size it was a year ago. We'd expect to easily maintain that growth rate for the next few years. And yeah, and it's like any business that's growing, it's, you know, as long as you get the right sort of people into it, it's very exciting, and you kind of just on a kind of winning on a winning curve for, you know, for hopefully for many years to come.
And do you feel you're having to look over your shoulder or across to anybody else that's also
Well,
into the same?
to be honest, I always keep an eye a little bit. I mean, like I knew Seccl when I was at Nucleus as well, and not in a detailed sense. Now, I always do. I've always done that, and I always think it's interesting to see what's coming into the market that is, you know, new or different, or people have thought about problems in a different or better way to what you might have. So we've never, any business I've been involved with, never been guilty of ever getting complacent, right, about that stuff. So I think we keep an eye on certain people who we think are super smart, doing interesting things. But we're probably, I think most of the time we're looking upwards rather than downwards, if that makes sense. But yeah, it'd be ridiculous to do all the hard work and build a wildly successful business then lose it all because someone's done it much more smartly than you have, you know. So that would be a bit foolish. But yeah, hopefully we won't do that. I mean, we we have a healthy respect for for the new entrants as much as we do for some of the legacy providers, you know. And some of the legacy providers we don't have respect for, you know.
Yeah, you were saying about the technology that you know it's important that that doesn't become out of date, but that has been a bit of a problem for the sector that
Big
you
time.
think you're
Yeah.
introducing new technology and you get your head around that, and then obviously it shifts.
Aye.
Maybe financial services has been a bit of a slower adopter than other
Definitely.
sectors.
Without doubt. Yeah, without
You've
doubt.
now got AI in the mix as well. So how
Yeah.
is that
Well,
playing?
I think AI is a fascinating thing because it's we've done quite well to get almost an hour into this without mentioning it, but it's one of these things that can have so many potential impacts, right? Positive and negative, or all around the place. I think if you're trying to do something with AI and you're poorly set up to start with, you're wasting your time, right? And you're taking on a bunch of risk. You don't know what you're doing. So I think there'll be a bit of a real life check on what is achievable with this stuff, right? So whether it's to make your operations more efficient, whether it's to start writing code, whether it's to whatever it might be. I actually think some of the stuff we see might be more interesting in the customer facing parts of the market. So how do we do financial planning in a way that's different and more engaging? That might be a thing more than we've got some little experiments going in Seccl just now where we use AI in different ways and different use cases for certain things. I think they're interesting and helpful, but also with a huge dose of respect for the fact we're looking after nearly 1 million people's money. And we take that very seriously. And we're not going to start throwing that away because of some cool new technology emerged, right? So I think I think you can look at these things either in terms of makes the business like more efficient and more, everyone's got a slightly better job than they had before because some of the easy work goes away, and that I can see quite easily. I think when you start saying it's going to transform absolutely everything overnight, I'm not sure I buy it, to be honest, because it does take a little while, even just for adoption. If we did this call like 10 years ago, everybody been talking about blockchain and that all funds are going to be on blockchain, and here we are. It's just starting to happen now. It's taken a long time, and then even if the technology exists, often the regulations don't necessarily keep pace with the technology. So you got the client money rules, whatever they might be. You're not suddenly no one's going to start ignoring them just because a new technology comes along. And so there's a whole bunch of stuff about, information security, about financial crime, about client money rules, about operational resilience, that anyone who just dives in and says AI is the answer to all of that, I think is going to fail and have a big, big accident. And that would be unhelpful for everybody.
Yeah. So, David, we were having this conversation this time next year. What would you have liked to have achieved in 2026?
Oh, do you know, I like to just have a smile on my face, and we're enjoying it and we're winning. I like that feeling. It's good when the team's feeling good, and we had an offsite meeting last week in Edinburgh with the whole company up, and it just feels like we're in a good groove. And yeah, if we bit more of that next year and more of the same, if we can keep this kind of growing at 300% or 400% per annum going for a few years, yeah, that will keep me pretty happy. And
Well,
and probably not without losing who we are, right, and without losing our values. And I don't think I don't think there's any risk of that happening, actually. But that would be the thing. I wouldn't want to have success at the cost of that.
yeah. Well, best of luck with it all. And obviously, don't forget about me when you've got to those heady heights.
Of course not. I wouldn't do that, Kate. Don't worry.
But brilliant. No, thank you, David. It's been wonderful to catch up with you. And
Cheers, Kate.
best of luck with it all.
Thank you, everyone. Cheers, now. See you soon. Bye.